Hey everybody, welcome to Retire with Style. I'm Alex and I'm here with my trusted companion, Mr. Wade Pfau. How are you, Wade?
Doing great. Hi, everyone. Welcome back to the show.
Yes, welcome back. You met me or everyone else?
Everyone. Yeah.
Okay, all
You
right.
too.
I can never be sure. Every Friday I get an email that says, hey, let's record next week. When I don't get those emails, I don't know. Maybe I did something wrong, right, Wade?
Could be. He could be in the doghouse.
The dread pirate Roberts. The dreaded Pirate Roberts, I think. What was I going to say? So we're coming off of our YouTube live session. What did you think, Wade?
Great questions. Yeah, it was good turnout. We've got plenty of questions to keep us going for a few episodes. So
What did you think about the answers? More importantly,
the
great
answers
questions. The answers were okay, or
they were on the top of the level. Although that was the day you weren't feeling so good. I hope you've recovered since then. And
yeah,
I
I
was
was.
doing most of the answering, so I have to say the answers were
I think you would have
A
probably been
plus.
doing most of the answering anyways, if I'm being completely honest. I'm the color man. You're the play by play. No, I was out of it, man. I think I slept. I just got home from Miami, and that weekend I think I slept 3 4 hours over 3 days. It was crazy. Just big high school reunion. You know how it
Oh,
is. Yeah, yeah, yeah.
what would that be for you? The 35th or so?
35th, 35th.
Wow.
Wow. So I could have done two like trips through high school.
Yeah,
From
yeah,
18th to 12th grade, right?
yeah.
My goodness.
Nothing like that to make you feel out of touch.
Yeah, it's all right. In a funny sort of way, I'm sure when we were kids, like my parents were like what my age is right now, and when you saw pictures, you were like, "Man, those people are old." It's funny, right? But when you're there, you think, "Oh yeah, I'm still like hitting my prime," kind of thing.
Oh yeah,
And I'm
yeah.
sure if we saw pictures of the reunion and everything, and we look at it, we all look like everyone's parents. You know?
Right in the old days, people when they were 30, they looked like they were 60 today. So I think less smoking is a big factor in that.
Well, these are a bunch of Cuban guys, so there's some cigars that they've been
Okay.
partaking in, but your point's well taken. How's that? But going back to the questions, yeah, it was a great YouTube live. Go to YouTube and check it out. We have it recorded, so you can go there and get your questions there. But something we did is we got so many questions, we knew we wouldn't be able to answer them all on the show. So we just still persisted and asked people to send us their questions so we could answer them in follow up episodes. So our next arc is really going through these questions since they're top of mind to folks. The idea is that if a couple of people have questions like this that are top of mind, then so do our listeners. So we'll be hitting these questions up, and again, it's a great way to reach out and be part of the community. If you're listening to this and you have any questions, send them in because we're gonna start recording the Q&As now, and there are gonna be lots of episodes on this. And so if you send a question in now, we could potentially answer that towards the back half of this Q&A. So feel free to keep on sending us questions. We're in our Q&A mode right now. Right, Wade?
That's right. That's right. And you mentioned going to the YouTube page to see the YouTube live, but actually it would have been the previous week's episode on the podcast as well. So
There you go. There you go.
yeah.
So go to the Spotify where you can listen to the podcast, or go to YouTube if you want to see Wade's wonderful face. Wait, I didn't realize how good looking you were.
Oh,
But the YouTube has really like made a difference for me.
yeah, really.
But I watched that on HD. Amazing, amazing.
All right.
What's your morning routine?
Try to shave. That's about it.
There you go. There you go. No exfoliation?
No,
Or you do
none
that
of
before
that.
going to bed? You do that before going to bed, don't you?
In the winter, I need some lotion or my skin gets
Dude,
a little
I'm
dry.
just
But
kidding. You don't need
outside
to.
of
You don't
winter,
need
no.
to. You don't need to humor me.
In the summer, nothing.
So in the winter, what was it again?
I'll just like face lotion.
Face lotion.
Otherwise, skin dries out
There you
in an
go.
uncomfortable way.
You heard it here, folks. No, nothing flakes on Wade. All right, man.
Okay, enough of the
Let's
small
get to it
talk.
then. Huh?
I'm sure some of the listeners are starting to think enough of the small talk. Let's
No, no, no.
let's dive in.
It became big talk after you started talking about your skiing routine. I think these are the questions people want to know. But all right, let's get to the first one.
All right.
Love the podcast. We'll see if they've listened to this intro. Been listening since the beginning, although I am a few behind right now. How about an episode opposite of what you normally cover? What the heck? What would that be? No.
Pre-retirement.
Normally, your show covers strategies used to avoid this tax or that. What do you do when you've been on the fortunate side of life? Let's say you started with nothing but work hard and a well paying job, kept the nose to the grindstone, and just kept investing. You didn't retire early but kept working. Not fire, instead, you didn't retire. Now there's no chance to do Roth conversions, I think. You might have continued to earn income at max. We're going to have to edit this. We did this question.
No, we didn't do this one.
Are
You
you
read it
sure?
before. You thought it was creative, but we didn't do it on the here.
Are you sure?
Yeah, I'm pretty sure.
All right. All right. Then the hell with the edit. We'll just keep on going. There was a very similar question.
This is one that came in advance of the YouTube live, and so we had reviewed those before going.
Okay. All right. My bad. All right. All right. So nothing happening so far, gents. Although this person's done very well for themselves, flexing a little bit,
They're not
but all
FIRE,
good.
they're
All good so
financial
far.
independence retire early. They're financial independence don't retire early.
Okay. So now there's no chance to do Roth conversions, I think. You might have continued to earn income at max rates until you were 70. Therefore, with the past few years of market gains, you have more money than you ever dreamed possible. There is no avoiding taxes. There's no avoiding that 85% tax on Social Security. You will pay a lot for Medicare because of the IRMA tax. Are there strategies left to use? Just pay taxes and be happy about it? Which is fine, by the way. Despite this success, you still worry about having enough, but also how when it is safe to start giving money to heirs so that you can see them enjoy it, or start gifting to charity. I know this has been covered. Anyway, just a thought.
Okay. Yeah. So, well, part of with the idea of tax strategies and things, I think there may be a lot of listeners who might relate to this kind of question, which is, well, I guess the basic idea is they're not necessarily overly concerned about running out of money. They've done pretty well. Their wealth has been growing. They've achieved financial independence, but continued to work, and so they have that income coming in. That does reduce the possibility of potentially having Roth conversions, especially they mentioned this pretty good income if they're in the top tax brackets still, say, as they get closer to age 70. There may be a number of listeners in this situation, and yeah, we can still talk about some ideas here. At some point, so for those who are doing quite well, it means you've probably been at least doing backdoor Roth contributions. You've got a nice Roth there. You have the choice of either with a 401k going in the Roth direction, but you may have been taking advantage of the tax deductions, making full contributions to a 401k. If you have self-employment income, you may have had a solo 401k to take full advantage of the employer contribution. And then you may have some surplus savings beyond that. And that's generally going in the taxable account. And so as you pass the financial independence threshold and you continue to make full advantage of savings into tax deferred and tax-free accounts up to their limits, and then putting the remainder, continuing to put more into your taxable account. At some point, you might get to the stage where just not that you're investing for dividends or anything, but a total return investment portfolio is going to kick off quite a bit of income just naturally as part of, there's a dividend yield, and if it's stocks, an interest rate if it's bonds. At some point, you might get to the level where you can comfortably live off the interest and dividends from your portfolio without having to sell any assets, or at least with Social Security plus just interest and dividends from the portfolio, you're meeting your full lifestyle. So then you're not necessarily worried about running out of money because you don't have to sell assets to meet your expenses. What can you do in that kind of scenario? On the charitable side, if you do have charitable intent, We have talked about the qualified charitable distributions before. It's actually in the YouTube Live episode. I think it came up quite a bit too, where this year you can, if you're at least 70 and a half years old, it's not 73 or 75 like RMDs, it's still that 70 and a half, you can contribute up to $108,000 directly from the IRA to a qualified charity and keep that money out of your adjusted gross income, which is a much more powerful way to contribute to charity than having a below the line deduction. These days, it's hard to take advantage of a below the line deduction. So you can apply that against RMDs as well. And so if any money that ultimately would go to charity, you don't want to necessarily Roth convert beforehand, because you're probably going to be paying taxes on that. And the charity, that money can go to charity without any sort of tax implication. There's also really no need to be thinking about harvesting capital gains, because you're never going to have to sell assets to meet expenses. So you're never going to have to worry about triggering long-term capital gains during your retirement. And there's a step up in basis at death for any beneficiaries beyond that. So no need to harvest gains. Really no need to be thinking about Roth conversions. I think we're going to have another question coming up later that had come in advance about like thinking about an annuity and a Roth IRA. And some of the themes we'll talk about with that one too. Like, you don't necessarily want other ordinary income if you're in this scenario I'm describing right now, because you're always going to have to deal with preferential income stacking. Of course,
that's a term that came up a lot during our YouTube Live thing.
Mm-hmm.
I'm just going to guess preferential income stacking is not a commonly used word among our listeners.
Mm-hmm.
Maybe just a little definition, because I think it's important with a lot of these questions what that concept is.
Yeah, so your qualified dividends and long-term capital gains, and in this scenario, you may not have long-term capital gains because you're not selling assets, but all the qualified dividends being kicked off of your taxable account every year, that is taxed at preferential rates. And there's a 0% bracket, and then a 15%, and then 20%. But that 0% bracket, well, that income stacks on top of your ordinary income. So it's a situation where if I don't have any ordinary income, it's for a couple right now, somewhere in the ballpark of $120,000 of long-term capital gains that'll be taxed at 0%. As soon as I start adding ordinary income, it's taxed as ordinary income, but then it's pushing my capital gains, that capacity I had at 0%, it's pushing a portion of that up into the 15% bracket. So it's like a double whammy. If I had ordinary income being taxed at 10%, but that's also pushing capital gains from 0% to 15%, I really have a 25% effective marginal tax rate there, and then a 27%. And so that can be a downside of having other ordinary income sources. Of course, you can't help Social Security, but you might not really voluntarily want, this is like the conversation around annuities and so forth. If you have those in your taxable brokerage account, that's generating ordinary income. So you'll be taxed on that. Plus you'll be taxed on the idea of pushing some of the equivalent amount of gains from 0% into 15%. Or at the more extreme level, the 3.8% surcharge could be applied to this idea, as well as the extra 5% tax as you go from the 15 to 20% preferential bracket. So that does speak to, in this kind of scenario, not necessarily wanting a lot of other ordinary income being generated through your taxable account. If you don't need the ordinary income, again, coming from your IRA, thinking about qualified charitable distributions for that up to their limits. And then the question also got into like gifting during your lifetime. So not necessarily just to charities, but potentially to your adult beneficiaries or your adult children, something along those lines. A really powerful feature in the tax code, especially if you are worried about estate taxes, is you have the annual gift exclusion limits. In 2025, they're $19,000, and that's from each person to each person. So if you have 3 kids, and if you're married filing jointly, a couple can give $38,000, from $19,000 from each of the 2 people. To each of those 3 kids, we're talking then about, in this case, more than $110,000 that you can gift, like as part of your estate planning idea, or as part of that inheritance, those annual gifts. And that's excluded from estate tax considerations. So thinking about something like that, if you feel sufficiently funded as well. Now, if you are in a scenario where you worry someday you may have to sell assets to meet expenses, long-term capital gains, and so forth, you could think about whether there's opportunities to gain harvest to help reduce the tax burden in the future when you have to sell assets for long-term capital gains, but maybe not.
And gain harvest for the uninitiated.
Is I voluntarily sell appreciated assets and then immediately repurchase them in order to pay taxes on that long-term capital gain, and then increase the cost basis for the asset.
And you would do that voluntarily because your current tax level for that particular year is lower than what it could be in the future.
Yeah, if you're not being hit by Medicare surcharges or Social Security, you're pretty much, especially taking advantage of the 0% bracket, you might as well fill that up with gains potentially. And then maybe you want to look at filling up the 15% till you get to the net investment income tax. Or in wealthier scenarios, you might go to a higher level. The highest you pay right now on long-term capital gains would be the 23.8%, which is the 20% rate plus the 3.8% Medicare surtax.
All right, Wade. And I know we had some questions. I'm going to skip the next one. Maybe we deal with that in the next episode. There's a good question here that you alluded to. It could be a good way to put a bow to an episode. And we'll see how far you get along. You get on with this one. In every married couple, oh boy, no, in every married couple, one of the spouses will die first. The second might stick around for a long time. How can the retirement plan hedge the risk of a spouse's death? Here's a use case. Married couple, husband is a main earner, wife is 3 years younger with little earnings. They have no pensions. Sub-$1 million in IRAs and 401ks. They're planning to take Social Security when he turns 70, which will cover a substantial portion of their needs budget. I assume that means essential expenses. Husband's PIA is $4,000. Social Security benefits at 70 will be close to $5,000. I assume that's monthly and all that.
Yeah, monthly.
Wife's benefit at age 67 will be $2,000 for a total family income of almost $7,000 a month. All right. Whenever the first spouse dies, benefits will drop to $5,000, a 28.5% reduction. Assuming the surviving spouse needs $6,000 a month, they will face a $1,000 deficit. At the same time, they will be facing a higher tax rate. I assume the right planning strategy will depend on the couple's RISA profile. If the couple's RISA style is protected income, and protected income means someone that values the commitment, values committing something that solves a lifelong problem, and contractual income. This desire for contractual income to put their liability of their future needs from their balance sheet and to put it on somebody else's balance sheet. All right. And so let me read that statement again. If the couple's RISA style is protected income, here's my thinking. If death happens late in life, a QLAC could be very attractive. So explain what that is. If the death happens early, term life could work, but the couple would need insurance on each of the spouses or a first death policy. If the death happens somewhere around life expectancy, neither of the above might be cost effective. So the couple should purchase a QLAC on the wife at 85 with 100% first death continuation and some term insurance for each spouse to the age of 70 to 80. If one of the spouses happens to die somewhere in the 5 to 10 year period in the middle, they only have a few low incomes years before the QLAC kicks in. I'm not sure if this is cost effective or there are other alternatives to consider. If the couple style is total return or time segmentation, all they need to do is keep appropriate reserves in their diversified portfolio. If their style is risk wrap, I am not sure what the options might be. What is a careful planner to do?
Okay. Yeah, so there's a lot to unpack with this question. And you mentioned QLAC, just to first define the term. That's the Qualified Longevity Annuity Contract. it's available in IRAs. It has the extra tax benefit of, while you're deferring income, not having to worry about paying on the not having to take RMDs for that particular asset. The idea is you might, at any younger age, whether it's 50, 60, 70, get a qualified longevity annuity contract that may not begin paying income until, I think the earliest is probably 75, but 75, 80, 85, something like that, where the income annuity turns on the income at that point. And so it provides that late in life protection. And the payout rates can get quite high if you're deferring, especially to 80 or 85, because a lot of people are passing away by that point. So you get those mortality credits really pushed together for you, and earning interest as well in the meantime. So that's a tool for providing that late in life tail risk protection. What if I live an extremely long time? Well, if I buy a QLAC that starts income at 85, it's going to pay pretty well at those starting at that age, providing me that late in life protection at a lower cost, because I get to skip the payments before then, where I'm more likely to live to receive those, and therefore that makes them relatively more expensive. So that's the QLAC. Now the just stepping back as well, because there's a lot in this question, right? The first, just the theme of what the question was about. If one spouse dies earlier than you were planning for, that can be a spending shock to the financial plan. Now, on the one hand, some of the expenses for the household will go down because it's less expensive for one person to live than it is for two people. But expenses won't drop in half by any means. There's still certain things that, like if you're living in the same house, all those expenses would pretty much stay the same. You still need a car, refrigerator, all that sort of thing. So it's just some expenses will go down after the death of the first spouse, but not necessarily a dramatic reduction in expenses. But also at the same time, you may lose some income sources. In particular, that spousal benefit from Social Security goes away. The larger benefit to the household becomes a survivor. Well, either if the worker's benefit, it continues as their retirement benefit, or if it's the lower income individual who survives, it becomes the survivor benefit for that individual. And then also the following year, you switch from married filing jointly to single filer status. And I mentioned how expenses don't necessarily drop in half, but a lot of the tax brackets, not all of them, but a lot of the tax brackets do drop in half. And so that can lead, a single filer may end up paying more taxes than the married filing jointly. In the case study I've looked at in Retirement Planning Guidebook, where they had about $2 million at the start of retirement, looking at that kind of situation, I was playing around with, well, what if one spouse did pass away earlier? The tax bill is going up by like $9,000 in that case study, just as a single filer, with the loss of that spousal benefit from Social Security. So less income, but still they had $9,000 more in taxes. And that's just one example, but it's a real idea. It's this idea of the widow's penalty. The surviving widow in a couple can be taxed at a much higher rate. So some expenses may decrease, but they also lose income sources and taxes go up. And so that's a spending shock potentially. Now, how to think about that? Well, this is actually one of the main motivations to think about Roth conversions at younger ages, in addition to just looking for opportunities where you're have less income, so you could potentially pay at lower tax rates. Taking advantage of that married filing jointly status is a big benefit too. Let's do Roth conversions to help reduce future RMDs, because if it's that single filer being hit by the same RMD as the couple's hit by, it's nice to have that RMD lowered, especially if you're not needing to spend all that income anyway. And so you're just reinvesting it, but it's pushing you into a higher tax bracket along the way. And then, so with this issue, the question's touching at so if you're safety first and commitment oriented, if you're income protection, the question's like discussing, how can I mix annuities with life insurance to potentially better hedge the longevity risks in the retirement plan, where life insurance gives you a much higher rate of return, so to speak, if you don't live very long. Annuities give you a higher rate of return, so to speak, if you live a long time. And so I think the person asking this question was trying to balance, well, what if we think about using both life insurance and annuities? but then structured it in terms of let's buy a term policy until, I think the question had said, through potentially age 75 or 80, and then buy a QLAC for the so that would protect against early death, getting that death benefit, and then to protect against a late death, getting the QLAC. That's certainly a possibility, but at these ages, term insurance can get quite expensive as well. And
Great.
yeah, in the world of like thinking about retirement income planning with life insurance and annuities, one of the strategies that gets discussed is called the covered asset strategy. And that's where you think about permanent life insurance. And the idea is that it backs the ability to purchase a single life income annuity. So taking another step back, if you think about joint lifetime annuities for the joint lives of two individuals, or if you think about like adding cash refund provisions on annuities and that sort of thing, that's really just a form of life insurance. You get a lower payout rate from the annuity because you're wanting to provide that protection that if one person doesn't live as long, the other person's going to get more financial benefit from that contract, whether it is because it's a joint life payment or because they're going to get a cash refund. So a single life-only income annuity will generally have a much higher payout rate than any sort of joint life or cash refund or that sort of thing. But it's scary to buy a single life-only annuity because then if you don't live very long, you don't get anything back out of the contract. You definitely wouldn't have gotten your money's worth out of the contract. But that's where this covered asset strategy is. I get a permanent life insurance policy, and then the death benefit really backs my ability to buy a single life annuity. If I say had a $500,000 death benefit, and then I put $500,000 into a life-only single life income annuity, if I live a long time, I get a lot more money out of that annuity. I still get my beneficiary will get the $500,000 out of the life insurance. The implied rate of return on that would be less, but overall it's hedged my longevity risk. If I end up not living so long, then the death benefit replaces that asset of the household. And the surviving spouse, if they so desired, could then use a portion of that to get their own life annuity. And so I haven't specifically tested this idea of trying to use a term policy for, say, the first half of retirement. But I'm thinking you're probably going to see more efficiency with this already established idea of the covered asset strategy, which is considering a permanent life insurance policy, which just means it's going to pay the death benefit even if you live to 100 or beyond. And so it will make the premiums more expensive, but then a term policy. But already, again, term's going to be pretty expensive if you're purchasing it at retirement to go on until, say, age 75 or 80. So looking at that and then looking at the savings then coming from the ability to get that single life-only annuity with a higher payout rate, but having the life insurance backing that asset, no matter how long you live, it's a way to help really calibrate your retirement spending to your life expectancy. So that would be at least something I would look at if you're thinking about what's the best sort of way to combine life insurance with annuities.
Okay, it's effectively you're using the life insurance for the longevity needs and the annuities for the current essentials. Kind of arranging deck chairs like that, which is nice.
You're hedging your lifetime because life insurance pays more if you don't live so long. The annuities pay more if you live a long time. So the two hedge each other.
Yeah, you're right. And don't forget, annuity is effectively like a life insurance policy, just in reverse.
Right.
Insurance in case you live a long time.
So, yeah, it's insurance against living longer than expected. Life insurance is insurance against not living as long as you were expecting or hoping, or whatever the case may be.
All right, Wade, that concludes the first set of our Q&As. You ready for more in the next episode?
Yeah, you're sure. We got through 2 questions. Yeah.
I told you.
Short and sweet.
These are meaty questions.
They were. Right. Yeah, not all the questions are this meaty, but yeah.
All right, everyone. We'll catch you next week on Retire with Style with more questions from our live audience.